For nearly a century, financial markets have been repeating the same pattern. Booms that feel unstoppable, crashes that feel like the end, recoveries that feel like miracles, and through all of it, one truth has emerged: most portfolios don't survive history, but a few positions do. Today, we're looking at the only 3 positions that have survived every major crisis of the last 100 years. The Great Depression of 1929, the inflation shock of the 1970s, housing collapse and financial crisis of 2008, the global shutdown during COVID, the inflation and rate shock of 2022. 5 different disasters, 5 different causes, 5 different economic conditions, yet only 3 types of assets protected wealth through all of them. This isn't about hype, it isn't about predictions. It's about what actually worked when everything else failed. To understand why these positions survived, we need to look at the crises themselves. In 1929, stocks didn't just fall, they collapsed. The Dow Jones dropped nearly 90%. Recovering those losses took more than 2 decades. People who were fully invested in equities saw their life savings wiped out. No diversification, no protection, no plan. In the 1970s, the problem was different. The US dollar weakened. Inflation went double digits. Stocks stagnated. Bonds got destroyed by rising rates. Even cash lost value every single month. It was a slow-motion crisis, the kind that eats your wealth without making any noise. In 2008, the financial system broke from the inside. Banks failed. Credit markets froze. Stocks fell by more than 50%. Real estate, supposedly the safest asset, crashed nationwide. Trillions of dollars in wealth evaporated in months. Then came 2020. No one expected a global shutdown. No one expected the world's economy to stop overnight. The entire system flipped instantly. Markets crashed, then soared, then crashed again. Volatility hit levels not seen since the Depression. And in 2022, the shock came from inflation and interest rates. The worst inflation in 40 years. The fastest rate hikes in modern history. Stocks fell. Bonds fell. Crypto collapsed. Even tech giants lost trillions of dollars. 5 crises, 5 different triggers, yet throughout every single one, 3 positions consistently protected wealth better than anything else. The first position has survived every crisis because it doesn't rely on anyone else's promise. No government, no central bank, no corporate earnings. It has existed for thousands of years and has never gone to zero. It is the ultimate hedge when the world becomes uncertain. The second position survived because it benefits directly from the power structure of the United States. It has outperformed in every era: high inflation, low inflation, war, recession, expansion. Whenever capital leaves risky assets, and whenever the economic cycle resets, this same position is where recoveries begin. The third position survived every crisis because it represents ownership of real production. Not speculation, not hype, not narratives, but actual economic value that humans need regardless of economic conditions. It is the position that historically rebounds faster than the broader market, recovers stronger after crashes, and compounds wealth across generations. Before breaking down these 3 positions, it's important to understand why most portfolios fail during crises. Portfolios fail because they rely on the same assets that everyone else is relying on. When markets are calm and money is cheap, risk looks like opportunity. Leverage increases. People take bigger bets. Prices go up faster than fundamentals. And when the cycle reverses, everything built on optimism collapses. Most portfolios fail because they don't prepare for volatility until it arrives. They assume every crash will look like the last one. They assume diversification means owning 15 stocks instead of 3. They assume bonds will always protect them. They assume cash will always be safe. But history doesn't reward assumptions, it punishes them. So what do the survivors actually have in common? They hold assets with intrinsic value, independent of external promises. They hold assets supported by large-scale capital flows that don't disappear in panic. And they hold assets tied to long-term production and human demand. The first crisis survivor is the asset that protected wealth in 1929 when banks failed and the dollar was unstable. It protected wealth in the 1970s when inflation destroyed the value of cash and bonds. It surged during 2008 as markets collapsed. It outperformed again during COVID and held strong through 2022's inflation shock. The second crisis survivor is the position that benefits directly from dollar dominance and US financial power. It survives because it sits at the center of global capital flows. When the world panics, money runs to safety, and this is where it runs first. The third crisis survivor is the position that represents ownership of real assets and real companies that generate real cash flow. Not speculation, not unprofitable narratives, but essentials. Together, these three positions form what can be called a 100-year portfolio. A portfolio that has not only survived every crisis, but often turned crises into opportunities. The first position is the crisis hedge. The second position is the global reserve asset. The third position is the long-term compounding engine. These positions behave differently in different crises. One protects during deflation. One protects during inflation. One grows during recovery. And when combined, they create a portfolio that doesn't rely on predicting the next crisis. It simply survives it. Most investors focus on the wrong question. What will happen next year? The right question is, what has survived for a century of unpredictable events? Because markets change, technology changes, politics change, monetary systems change, but the core patterns of human behavior do not change. Fear, greed, trust, and panic. These are constants. And the portfolio that survives is the portfolio built around constants. As we break down the three positions, remember, the goal is not to beat the market every year. The goal is to avoid destruction. Wealth is built not by making huge returns in good times, but by avoiding catastrophic losses in bad times. And throughout history, only three positions have done that consistently. The story of financial survival over the last century is not random. It is not luck. It is the result of holding positions that behave differently from each other under extreme pressure. The three crisis-proof positions do not survive because they are perfect. They survive because they fail less often and recover faster than everything else around them. To understand why these three positions worked, we need to look deeper at how wealth is destroyed during major crises. Most investors lose money in panics, not because they chose bad assets, but because they were exposed in the wrong way at the wrong time. Too much risk during inflation, too much leverage during deflation, too much speculation during booms, too much fear during recoveries. Crashes punish concentration. They punish assumptions. They punish the belief that one asset class will protect you forever. But throughout history, three positions held together create a balance. One gains when the economy slows. One gains when the economy heats up. One gains when production recovers. This natural balance is exactly why these positions survived the Great Depression, the inflation storm of the 1970s, the global meltdown of 2008, the chaos of the pandemic, and the inflation shock of 2022. The first crisis survivor is the ancient one, the position that requires no trust in political systems or financial institutions. It exists outside of quarterly earnings, interest rates, or central bank decisions. It is slow, steady, and powerful because value flows to it when fear takes over. During the worst moments of 1929, when banks were shutting down and confidence in the financial system was collapsing, this position protected purchasing power better than almost anything else. During the 1970s, when inflation destroyed the real value of cash and bonds, this same position surged for an entire decade. It did the opposite of what paper assets did. When the dollar weakened, when wages struggled, it held firm. When interest rates soared into double digits, it preserved wealth like a shield. In 2008, the world once again turned toward this position as markets crashed globally. It did not explode upward in a straight line, but it held and it recovered faster than many other assets. When the pandemic hit in 2020, the same pattern repeated. Confidence collapsed. Production stopped. Entire industries shut down. People rushed back to safe stores of value. Fear always follows the same pattern. And capital always responds. The second crisis survivor is the complete opposite. It thrives not because it is ancient, but because it sits at the center of modern global finance. It is backed by the largest economy in the world and supported by trillions of dollars in global capital. It does not surge wildly during panic. Instead, it provides stability when everything else becomes unpredictable. In 1929, it did not lose anywhere near as much as equities. In the 1970s, it did not collapse the way stocks did. In 2008, when the world was panicking and liquidity dried up, this position became the safe harbor. Money rushed into it because investors trusted it more than anything else. Even during COVID, when markets became violently unstable, this position provided safety because it is the foundation of the global financial system. This second position survives crises because of one truth. When the world panics, it runs toward the United States, not away from it. The global financial system is built around the US. This position benefits from that structure. The third crisis survivor is the one most people overlook. It is not flashy. It is not hyped. It is not speculative, but it is essential. It represents ownership in companies and assets that produce real value, real cash flow, and real necessities that people cannot live without. This position recovers faster than the broader market because human needs do not disappear during recessions. During the Great Depression, many of these companies continued operating because even in the worst economic conditions, people still needed food, energy, transportation, and basic goods. In the 1970s, when inflation destroyed consumer spending, this third category held firm because it dominated industries that benefit from pricing power and long-term demand. In 2008, the companies in this category fell along with everything else. But they recovered stronger and faster because they were never built on speculation. They were built on production. During the pandemic, they were among the first to rebound because demand for essential goods remained strong, even when the world was locked down. And in 2022, when inflation and interest rates crushed tech and crypto, these positions provided stability because they were tied to fundamental value, not hype. Individually, these three positions are strong, but together, they form a portfolio that has survived almost every destructive event in modern financial history. The reason goes beyond performance. It is about correlation. These assets do not move together. When one falls, another rises. When one stagnates, another grows. When one becomes volatile, another becomes stable. Diversity is not about owning many things. It is about owning different things. Most investors think they are diversified because they own a handful of stocks, maybe some tech names, some value names, and maybe a little cash. But this is not diversification. It is concentration disguised as variety. Real diversification comes from holding assets that are driven by different forces. The first crisis survivor is driven by fear and declining trust. The second is driven by global capital flows and economic stability. The third is driven by production, cash flow, and long-term human demand. Because each position responds to different economic forces, they form a natural hedge against each other. That is why this three-position structure worked in the 1930s despite deflation. It worked in the 1970s despite inflation. It worked in 2008 despite credit collapse. It worked during COVID despite global shutdowns. It worked in 2022 despite interest rate shocks. Across all of these events, one theme appears clearly: no single asset survives everything. Stocks cannot survive every crisis. Bonds cannot survive every crisis. Cash cannot survive every crisis. Even real estate fails during certain shocks. But a three-position structure can survive because it does not rely on a single environment. It is designed to adapt automatically to whatever the world throws at it. To understand why these three positions are so effective, think about how different crises destroy wealth in different ways. In a deflationary crisis like 1929, asset prices collapse because demand disappears. In an inflationary crisis, like the 1970s, asset prices collapse because the currency loses value. In a credit crisis like 2008, asset prices collapse because the financial system stops functioning. In a pandemic like 2020, asset prices collapse because the real world stops functioning. In an interest rate shock like 2022, asset prices collapse because borrowing becomes too expensive. Each crisis destroys portfolios from a different angle. That is why most investors lose. They build portfolios that might survive one type of crisis, but not the others. The three-position portfolio survives all of them because each position responds to a different category of danger. The first position protects during inflation and currency weakness. The second position protects during deflation, panic, and liquidity crunch. The third position protects long-term wealth and accelerates portfolio recovery after the crisis ends. This is why wealthy families, sovereign funds, and institutions hold these three positions at all times. They do not try to predict the next crisis. They prepare for all of them. When investors attempt to predict the next big crash, they almost always guess wrong. Sometimes the danger comes from inflation, sometimes from credit, sometimes from geopolitics, sometimes from systemic failure. But the three-position framework does not care about the cause. It only cares about survival. The lesson from the last 100 years is simple. Survival is not an accident. It is a structure, and the investors who built this structure were not smarter than everyone else. They were simply prepared for more scenarios than everyone else. These three positions are not magic. They do not eliminate losses. They reduce destruction, they reduce volatility, they reduce the probability of catastrophic failure, and most importantly, they allow wealth to continue compounding even when the world becomes unstable. The question for modern investors is not whether another crisis will come. It will. The question is whether their portfolios are built on hope, or on history, because history has already shown us what survives. The deeper you study a century of financial history, the clearer the pattern becomes. Every generation believes their crisis is unique. Every generation believes the world has never seen anything like this before. But when you strip away the headlines and the emotion, the mechanics of wealth destruction and wealth survival follow the same script over and over again. That is why the three-position portfolio is not a theory. It is a reflection of how markets actually behave under pressure. To understand the strength of the structure, imagine each position as a pillar. One pillar stands strong during inflation. One stands strong during deflation and panic. One stands strong during recovery and expansion. A portfolio built on these three pillars does not collapse when the world shifts from one environment to another. It bends, but it does not break. And that bending effect is one of the most misunderstood advantages in long-term investing. Consider the investors who held only stocks right before the 2008 crash. They watched their portfolios fall by more than 50%. For many of them, it took over 5 years to recover. If they panicked and sold at the bottom, they never recovered at all. Now imagine an investor who held the three positions. Yes, the equity pillar collapsed, but the second pillar, the safe capital pillar, rose sharply as global markets panicked. The first pillar held steady as confidence in the system weakened. The result was not a catastrophic loss. It was a manageable decline. And after the crisis passed, the third pillar, the essential production pillar, helped accelerate the recovery. Now consider the inflation storm of the 1970s. Investors, holding cash and bonds, watched their real wealth fall year after year. Prices rose faster than interest payments. Savings accounts became traps. Retirees on fixed income suffered the most. But the first pillar, the inflation-resistant pillar, soared during that decade. It protected purchasing power while almost every traditional asset collapsed. The safe capital pillar struggled in real terms, but remained liquid, and the essential production pillar continued generating cash flow because demand for basic goods remained strong. Move forward to the pandemic. The global shutdown created a once-in-a-century liquidity shock. Markets collapsed in weeks. Tech stocks plunged. Entire sectors disappeared. But again, the three-position structure absorbed the shock differently. The inflation-resistant pillar held steady. The safe capital pillar strengthened as investors rushed to safety. The essential production pillar dipped but recovered quickly because human needs never disappeared. Once again, survival came not from predicting the crisis, but from being structurally prepared for it. This is the core truth. No model, no forecast, no newsletter, and no analyst can predict the next crisis accurately or consistently. But structure does not require prediction. Structure only requires discipline. And most investors do not want discipline. They want excitement. They want narratives. They want the thrill of doing what everyone else is doing. But markets do not reward thrill. They reward resilience. And resilience is built from structure. Another powerful advantage of the three-position framework is psychological. Crashes do not only destroy portfolios, they destroy confidence. When investors watch their life savings fall by 50%, they make emotional decisions. They sell at the worst possible moment. They panic into the wrong assets. They follow the herd directly into more danger. But a three-position portfolio reduces the emotional shock. If one pillar collapses but the other two hold firm, the investor does not feel the same panic. They are far less likely to make catastrophic decisions. And this psychological advantage often becomes the difference between long-term failure and long-term survival. There is also a mathematical advantage. Investors underestimate how long it takes to recover from major losses. A portfolio that falls 50% needs a 100% gain to return to its starting value. Most investors never achieve that recovery because they panic, switch strategies, or take on more risk at the wrong time. But a three-position portfolio rarely faces such extreme losses. Even during the worst crises, the decline is far smaller. Smaller declines require smaller recoveries, and smaller recoveries happen more reliably and more quickly. That is why compounding continues, even when the world becomes unstable. But the most overlooked advantage of the three-position structure is option. During every crisis in the last century, the investors who survived were not just protected. They were positioned to take advantage of the moment when panic created generational buying opportunities. This is a critical distinction. Survival is not the goal, prosperity is, and prosperity happens when you can act while everyone else is perishing. The safe capital pillar gives investors dry powder during crashes. While the world sells assets at the bottom, this pillar gives the investor the ability to buy at the lowest valuations in years. The essential production pillar provides income during recessions, allowing investors to accumulate more assets while prices are suppressed, and the inflation-resistant pillar protects purchasing power so that when opportunities arise, they can actually be taken. History shows the same pattern. After 1929, those with available capital bought stocks at the cheapest prices of the century. After the 1970s, those holding strong stores of value rotated into productive assets before the markets exploded in the 1980s. After 2008, those who stayed disciplined bought high-quality companies at historic discounts. After the pandemic crash in 2020, those with liquidity bought into one of the fastest recoveries ever recorded. And after the inflation shock of 2022, disciplined investors rotated into sectors that benefited from higher rates and global instability. In every single case, the same principle appears. Investors with balance gain wealth after crises because they do not have to repair damage. They can take advantage of opportunity. That is the true power of the three-position structure. But building this structure requires understanding what each position actually represents. The first pillar is not a speculative bet. It is not a way to get rich quickly. It is insurance against currency weakness and systemic distrust. It is wealth preservation in its purest form. The second pillar is not a risk-free asset. It is simply the most trusted form of capital in a world built around the United States. It provides stability, liquidity, and option. The third pillar is not a guarantee of constant growth. It is exposure to real production and essential demand that will exist regardless of the political cycle, the interest rate cycle, or the technology cycle. These three pillars represent three different types of economic behavior: fear, stability, production. Together they create a complete view of the financial world, and that completeness is what makes the structure durable under stress. Now imagine the next decade. Debt levels are higher than ever. Inflation is not fully under control. Interest rates remain elevated. Geopolitical tension is rising. Supply chains are unstable. Demographic shifts are reshaping consumption. Technological disruption is accelerating. There is no single path forward. There are dozens of possible futures. Some futures involve inflation. Some involve deflation. Some involve stagnation. Some involve expansion. Some involve geopolitical shocks. Some involve financial instability. Predicting which future we will get is impossible. Preparing for all of them is not. That is why investors who study history are not surprised when crises arrive. They expect them. They understand that chaos is not an exception in financial markets. It is a recurring feature, and that understanding allows them to build portfolios that endure rather than collapse. The three-position structure is not perfect. It is not designed to make the most money in bull markets. It is not designed to impress people with fast gains. It is not designed to track the latest financial trend. It is designed for one purpose only: survival through uncertainty. And history shows that those who survive the worst moments always outperform those who chase the best moments. The final lesson from the last 100 years is simple. You do not need to predict the next crash. You do not need to guess when the next bubble will burst. You do not need to time the market. You only need to build a structure that works, whether the future is bright or dark. And the three-position portfolio is that structure. Because if something survived the Great Depression, the inflation storm of the 1970s, the credit collapse of 2008, the global shutdown of COVID, and the interest rate shock of 2022, then it is not luck. It is not chance. It is not coincidence. It is resilience. And resilience is the closest thing to a financial superpower that any investor can have.